This year established stock markets have continued to soar to new record highs or thereabouts, stretching valuations as they tick higher. But history teaches us that bull runs never last forever, and eventually markets will plunge into a bear territory, or even worse, face a full-on crash. When exactly this will happen is anyone's guess, so unless you have a fully functioning crystal ball, having a contingency plan is good practice. This plan B is the thing that will support you when it feels as if the bad days just won't stop coming. Here, we explore how you can shield your portfolio against devastating financial losses. Warren Buffett's first rule of investing is not to lose money, although this is something that is particularly difficult to achieve. The second best tactic is to protect yourself as much as possible. Therefore, while investors continue to revel in the 8-year bull market, the second strongest in history, it's important to have a plan B built in for if it all comes crashing down. Stock market valuations in the U.S., in particular, are almost as high now as at any time in the last 300 years, according to Brian Dennehy, Managing Director of investment research firm Fund Expert. He adds that history suggests the downside from here could be more than 50%. Your contingency plan can be the thing that you turn to when you are worried that markets are falling, such as an instruction not to panic and sell out when prices are low, but it is better to incorporate it into your actual investing strategy. We look at how to do that. Below.Stop-losses can be a useful part of a wider Plan B strategy. The knowledge that you have stop losses can give you the confidence to invest and stay invested despite apparent overvaluation. You don't become obsessed with and distracted by is valuations. So there is no guarantee that your stop-loss order will be executed, even if the share price reaches the stop price you have set. This is because share prices can change in seconds, and if a share price has moved by the time your broker attempts to place your deal, it may not be executed at the price you have set, or at all. There is no hard and fast rule on what level stops should be placed. However, you should think twice before setting a low-level stop-loss in fast-moving market conditions. What's more, it's ill-advised to set, for example, a 7% stop-loss on a stock with a history of fluctuating by 15%. Doing so is likely to cost a pretty penny in order execution costs levied by the broker. The key is to pick a level that provides ample berth for stocks to fluctuate and limits as much downside risk as possible. While there is no perfect answer, the most effective stop-loss method was selling on a 10% fall, in Dennehy's experience. Typically there is a price for a stop-loss. You achieve less volatility, but at the price of less growth. She said a portfolio comprising of between 12 and 15 funds investing across different asset classes will see most people right. Anything more and you risk the cost of holding the funds having a significant dent on your investment returns. McKay added, I tend to use active funds for those markets which are less well-researched than the massive US and UK markets, for example emerging markets, or sector specialist funds, or funds that show conviction in select fewer shares, and that don't just hug an index. But if you're holding a large generalist fund in a mature market, which has been underperforming the index for a few years, it's probably time to reallocate to either a passive fund or an active fund which earns its crust, unless there's a very good reason to hold on. Traditionally, the safety counterweight to shares in an investment portfolio has been bonds, with the safest option considered to be the top investment-grade country's debt, as these are least likely to default. If you want to take absolutely no risk with your investments, that's what you buy. Most people should at least take some risk, and with that you buy the equity markets, and then you combine these two things according to your risk profile. Moving a portion of your investments into cash can be a good low-risk and short-term solution for investors. You forego potential gains, but it shields your money against a reduction in value when stock markets do fall, while providing ammunition to buy in at knockdown prices. The problem with cash is it generally offers a low return compared to other investments. To put this into context, An investment of £100 in the UK stock market in 1945 would have been worth £179,695 by 2015 with dividends reinvested, compared to £6,261 if saved in cash, according to the Barclays Equity Guild study. The real value of cash returns has been eroded here in the UK because of rising inflation. The recent hike 0.25% in interest rates to 0.5% offers little respite. The difficulty for investors is weighing up the opportunity cost of holding a cash reserve when it could be out there working harder for you. The actual amount you should hold in cash depends on your attitude to risk, and you should also look at your wealth as a whole here. In retirement, this could rise to between 1 and 3 years as expected income.The reason for this is during retirement the volatility of markets can have a significant and detrimental effect on your retirement income, because retirees are taking money out of their pot and not adding to it. It is difficult to know when exactly to initiate a Plan B strategy, although whenever you are getting worried is a good time to look at it. Investors need to be clear on whether their portfolio is doing badly because markets are down, or because they have picked poor funds, sectors, or regions, said McKay. Ask yourself whether this is just part of the bumpy ride, or if there's a bigger problem, she advises. One of the biggest reasons that hobbyist investors underperform is because they can't resist the urge to tinker. It is good practice to check out research from renowned investment experts to help guide your view before making any adjustments to your portfolio. For Ben Kumar, investment manager at 7 Investment Management, having a range of funds investing across different asset classes in the portfolios he manages means he is hedged against market downturns. He said the results of numerous stress tests on the portfolios run by the wealth manager revealed that should the FTSE 100 fall by between 15 and 20%, they would only capture between 4 and 8% of the downturn because of diversification. Sticking to your plans and not tinkering with your portfolio with every movement in the markets is actually quite important. The danger with having a hard trigger finger is markets are not efficient, so there are occasions where they will move violently one way then snap back. The reactions of the UK markets following the Brexit vote is a good example of this. It is about knowing what your investment goals are, what your time horizon is, and your appetite to risk.